Hi, over the last few weeks I've noticed increasing nervousness amongst property investors, and it's not just the beginning investors I speak to wondering whether they should get into the market. I've also noticed some concern from some investors with substantial portfolios. Now look, only yesterday I got a phone call from a professional colleague who'd been investing for many years, but now he had the jitters after reading that Jeremy Grantham, who's apparently a legendary US investor, warned that Australia had an unmistakable housing bubble and that prices would need to come down by 42% to return to long-term trends. Now, is he right? Are our property markets going to crash? Well, before I give you my thoughts, for what they're worth, let me share some other concerns I've heard over the last few weeks. Some investors are concerned that property prices have risen too high, too quickly, particularly in Melbourne and a bit in Sydney and Darwin, and they're worried that prices may now drop. While others are concerned that they've been priced out of the market and they're wondering, is it too late to get in? Yet others are worried about whether interest rates are going to rise further, and if they did purchase a property today, whether they'd be able to hold on to their property. Now, it's understandable why so many property investors are nervous. Last year, while the rest of the world suffered, Australia avoided going into recession, didn't it? And we felt confident, in fact we were a little bit smug, and thought that the worst was behind us. Well, with all the good news in the media, buyers are out in force and set some of our property markets on fire. But now, the messages are changing. It's no longer just good news. There's good news followed by bad news followed by mixed messages. Most people, even some experts, don't know exactly what's going on. Or more importantly, what's going to come next. So no wonder most property investors don't know what to do next. Now, while Australia's economy has performed well, and is likely to continue to do so, we don't operate in a vacuum. We're part of a global economy, and one that still has problems. While America's slowly working its way out of its problems, but it's got a lot further to go, the extent of the problems in Europe are just coming to light, aren't they? And if history repeats itself, there's going to be plenty of more surprises, maybe some shocks. And these may have a negative impact on the Australian markets, and in particular our finance markets. Now, I know Rolf Schaefer, Director of Metropole Finance, is concerned that if the Australian banks have difficulty raising money overseas, they may follow the trend already evident in England and Canada, where they lower the loan to value ratios for investment properties. Okay, well, I see our housing market softening in a couple of months. Now, by this I mean that price growth will slow. It doesn't mean that property prices will fall, but they may in some areas, particularly at the bottom end of the market, especially if interest rates rise again too soon. It's more likely that the market will eventually just get back into its equilibrium, in contrast to a sudden sharp fall like some of those doomsayers are predicting. Look, think about it. It's unlikely the government or the Reserve Bank would allow such a correction to occur. Well, what about all the talk about unaffordability and how that's going to affect the market? In his recent newsletter, property analyst Michael Matusik says that while it's true that residential property is more expensive relative to household incomes than it once was, this imbalance isn't as drastic as some doomsayers think. Matusik suggests that a better measure of affordability is mortgage size versus household income, which is around a ratio of 3 across Australia from maybe 2 a decade ago. Matusik explains that when looking at the middle to upper end of Australian markets though, and that's the area where they've got 3/4 of our residential property, the ratio is really just 2. He goes on to say that on average, Australians hold 80% equity in their dwellings. That's a lot, isn't it? Not loan, equity, even higher for the principal place of residence. He goes on to explain that when we're looking at Australia's leveraging, when playing mortgage size against household income, it's actually declined over the last 5 years. And he makes an insightful comment that unless we're going to see our banking system totally collapse, he can't see how house prices across Australia are going to lose close to half their current value in a short, sharp crash. And even more in the long term, such deflation seems really, really unlikely. Now, the Reserve Bank Deputy Governor Rick Battolino also recently commented that house prices in Australia, relative to income, were reasonable. To me, this should give comfort to those worried by the many predictions of economic disaster. If you pit the headline-seeking doomsayer brigade against the Reserve Bank, I'd believe the Reserve Bank any day. Also recently, David Airy, the president of the Real Estate Institute of Australia, slammed the comments by Grantham. He went on to explain that the REIA's data highlights that historically, median prices compared to income have been relatively stable for the last 10 years, taking into account the sort of normal fluctuations. So Airy went on to say it's important to note that price-income ratio doesn't entirely explain the state of house prices. He explains that demand fundamentals such as interest rates and stocks and the return you get from stocks also needs to be considered. As well as these fundamentals, he actually went on to talk about the structural factors such as population growth and the undersupply of housing. So he went on to say what is evident from the data recorded by the REIA is that we're not seeing a housing bubble developing, not one that's going to implode, but rather just the normal cyclical changes of the Australian housing market. Okay, so what should a property investor do? Firstly, it's worth remembering that the fundamentals that started this property cycle are still there, and there's no doubt that property values will continue to increase, but now more slowly and more selectively. We still have a strong rising population, yet at the same time a shortage of supply of properties to meet this strong demand. And this is showing itself in rising prices and low vacancy rates. We're just not building enough properties, and those that we're building are coming on stream at a much higher building cost. And of course we've still got relatively low interest rates. But one factor that boosted the market, consumer confidence, is now faltering a bit. The growth of the markets in Melbourne and Sydney in particular, and Darwin recently, were unsustainable. In some ways the property markets got a bit ahead of themselves. They're now taking their breath. This is normal. Property prices don't increase in a linear fashion. They go up in little booms, then catch their breath and go up again, and sometimes they even drop a bit. But they keep moving up. But let's be clear, not all properties are going to increase in value equally. Properties in regional Australia and in the outer working class suburbs will be more interest rate sensitive, because this is where homeowners, and they're the ones who really drive the property values, are more sensitive to interest rate rises and to affordability issues. On the other hand, homeowners in the inner, more affluent suburbs, they generally have more disposable income. And if you think about it, their income isn't as dependent upon the CPI rises, because these people have got businesses, they've got property investments, they get bonuses in their work, they've got more disposable income, and they're more likely to be able to afford higher property values. They've got more discretionary income. So this is going to create a two-tier property market, with some properties rising in some areas and others not as much, or at all. Values will increase in the inner, more affluent suburbs and not as much in the outer working class areas and in regional Australia. Now, as property investments a long-term play, I suggest you get into the market now by purchasing the right type of property. One that's going to give you that's going to be in continuous strong demand by owner-occupiers, because remember, they're the ones who push up prices, and a property with an element of scarcity. If possible, buy one to which you can add value, because this is going to increase your capital growth in the next little while at a time when general capital growth will be lower. Then you just sit back and allow the magic of time, leverage and compounding to work its magic. Now, over time, I'm going to keep you updated on how to take advantage of this property markets in future updates like this. But it's probably also appropriate to remind you that in changing times like this, no one can quite help you like the independent property investment strategists at Metropole. Now remember, the multi-award winning team of strategists at Metropole have no properties to sell, so their advice is independent and unbiased. So if you'd like to find out a bit more about what's happening in your local market and what our research is suggesting is in store for us, please join us at a free property briefing in our offices in Melbourne, Sydney or Brisbane, or with our associates in Perth. Just click on the link below to find out more and reserve your place. Boy, there's so much happening in the property markets nowadays. I'm going to keep you updated 2 or 3 times a week in my blog. Just click Michael's blog up at the top there in the top menu item, bookmark it, and then come back often to keep up to date, or go to the property news page. You can also follow my regular property news updates on Twitter. Just click the link below.